Asia and the direction of travel through the day. We've seen the oil market in Asia trade up this morning, up over 1%. And after a strong recovery yesterday, having sort of done a very, I suppose the message of the moment, volatility, and yesterday was sort of exhibit A, where we saw a significant drop in the markets in the early half of the day, some 7-8%, and then a recovery by the end of the day. So volatility very much in the air. I'd like to start this morning with take advantage of the fact that we have Reem Shamsuddin joining us this morning, because of course Reem, a journalist now based in Europe, but was many years Reuters correspondent in Saudi Arabia. And Reem, as we look at all of the pieces of this global picture at the moment, obviously the Ukraine war, oil prices and the impact of that, OPEC Plus are meeting today. And in the messaging going into the meeting, the Saudis have been very pointed in their geopolitical comments regarding the conflict with Yemen and the Houthis, and in essence, the lack of protection or support that they feel they're not getting from Washington. How do you read that at the moment, the messaging from Saudi? What are they trying to say? How serious do you think it is?
Yeah. Hello, John.
Hello.
Good morning.
Hello.
Can you see?
Come in, Italy. Italy, come in, Italy.
All right. Can you see me, because my picture is frozen?
Yeah, clear and sound crystal.
Yes, thank you. The message that Prince Abdulaziz was very vocal this week, actually in Dubai, when he was attending a conference there, about the need for the world to act together to protect supplies coming from the world's largest oil exporter, because we cannot afford to lose any more barrels in the market now that people are complaining about tightness and tighter supplies coming due to many aspects. They blame OPEC for not pumping much or increasing production. The geopolitical aspect is still weighing very much on the oil market still. We have analysts saying that, this is not going to change, because as long as there's the war, we have a big a geopolitical premium weighing on the price. At the same time, the message from OPEC and OPEC Plus is that the market fundamentals are not haven't changed much. And OPEC is not a political institution or organization. The role is to stabilize the market. At the same time, Prince Abdulaziz mentioned that there has to be more in terms of protecting energy security and infrastructure. Because we cannot afford to lose, as I said, any more barrels in the market.
And in that regard, just to follow up from the point of view of Saudi Arabia's position with the conflict in Yemen and with the Houthis, they want this war over? They want the Americans to do what to the Houthis? What do you think is their top one or two wish list that they want the Americans to do about Yemen?
I think now there are talks about some truce happening, especially during Ramadan. Ramadan starting on Saturday, I believe. So there will be a truce happening and some talks, hopefully to end this war. Riyadh is going to host them. I think it's already happening now. So there is an urgency to have one collective act to, as I said, protect energy infrastructure. And if the world needs more oil, there has to be more protection when it comes to energy infrastructure. And yes, I believe so. Oil and politics is not all the time disassociated. They're related, one related to another. So yes, if the world needs more oil, there should be more protection. I don't know about behind closed door talks.
Yes, yeah,
between Washington
more protection.
and...
I mean, it just seems that they're being quite vocal in their displeasure with Washington, and I'm just still struggling to see exactly what I mean. Rebranding the Houthis as a terrorist organization, what does that achieve in essence? I mean, obviously it changes the Washington dynamic a bit, but let's move on to Matt Stanley, director of Star Fuels. Matt, we have as our top story this morning on our digest just a kind of an overview point that global oil supply disruptions are now approaching 5 to 6 million barrels per day. If you include Iran, Libya, Yemen, or not Yemen, but Yemen as well, I suppose, in a small way, but Iran, Libya, Venezuela, now Russia. There's a lot of supply there potentially that could come back to the market and not immediately, but ultimately in not a long period. Your thoughts on where that oil supply demand balance is right now? Because clearly the oil markets are in a shock and awe moment, but ultimately there isn't a real shortage as of yet.
Well, no, that's a good point. It's morning everyone, by the way. That's a great point, Sean. And one that I mentioned, there's three things there. One is I mentioned when Diallo was moderating the other week, is the Iranian issue, I think, is going to be pressed harder and harder by the EU, because the Iranian light grade is a like-for-like replacement for Urals. That's what the German refining diet runs off. And if you look on the sort of crude chart, literally, you will see that Iranian light can substitute. So I think the EU could use that as a bit of leverage if Russia oil continues off the market. Libya and Venezuela, I'm politely dismissing, because Libya has never been a consistent producer, hasn't been for the last 10, 12 years. So to factor that in as consistent supply is dangerous. Venezuela, look, that's another interesting one. I saw an article yesterday that Chevron were getting back into Venezuelan oil production. I thought, well, there must be some talks there, with the powers that be, with the Biden administration. I don't know. Again, I think that Venezuela needs to be, for the prompt at least, needs to be dismissed. How much do we anticipate, or does the market think is offline? And I use that in the loosest term from Russian oil. Look, I think it will be a tough 3 months. Q2 will be tough for the oil market, and we will see about 2 to 2.5 million barrels a day of supply-demand deficit. I do think that's the case. Jet fuel is coming back slowly but surely, and oil demand is back to where it was pre-COVID. Supply is not. Now, what will happen is we will just see a change in trading patterns. The oil will still flow. It will just be how it gets to the market. And case in point is the way that India are positioning themselves. And I hope Narendra is listening, because he was so vocal when he was on with you the other week. I thought he was going to come through the screen. It was amazing. But it's a very good point. And, in the India-Russian discussion is going to be very interesting. Pertamina, state oil company of Indonesia, yesterday, they came out and they said, we will buy Russian oil, and we are in touch with our Indian friends to sleeve the payment through India. Now, this raises a lot of concerns, but one thing it does to me is that you are seeing a fracture between understanding of how to deal with the Russian issue, by the EU and the US, and then growing economies in Asia that view oil feedstock, the cheapest they can get, the better it is. So I think that we will see that fracture get wider and wider. And I think, the likes of Vietnam, Thailand, they haven't come out yet. So I hope they don't shoot me down for thinking that they're supporting Russia. I'm just saying that Indonesia came out yesterday and said that they would use India as a possible payment conduit. Those discussions that the US will have with India, I think, will be incredibly interesting. But yeah, look, about 2.5 million is the supply-demand deficit that I see for Q2.
Well, there's certainly in the politics of things there. I mean, as you say, there's the economic opportunity, and who doesn't like a basement bargain price, but there's also the personal politics of relationship. We're seeing even Gerhard Schröder, the former chancellor of Germany, unable to condemn the Russian invasion of Ukraine. And so the personal relationships that Putin has with Modi in India, I think that's also a big part of the component here, as well as the aligned politics, the same perhaps in China. Let's go to Victor Yang, senior editor at JLC Network Technology, because of course, Victor, in terms of the volatility we saw yesterday and recent days, there's a question mark emerging as to how significant the COVID lockdowns are in China and what impact it will have on demand. I welcome your answer to that question.
Yes. Well, I believe there's been a lot of coverage on the COVID situation in China nowadays as well, because, well, the country has been largely successful in containing the virus before March. And now we have reported over 1,000 cases of indigenous cases were confirmed cases a day on a daily basis, and thousands of asymptomatic cases were particularly in Shanghai. So as you know, Shanghai has been locked down for 2 days. Half of Shanghai, not the whole city, but the other half will come under lockdown.
Shanghai is a bit like Budapest. There's two sides to the city with the river in the middle. One side is closed while the other side is open.
Yes, that's true. And they will be locked down separately for 4 days. Well, and you know, Shanghai is a very big city. It has a population of 25 million. You just imagine the population, 25 million, close to a small country. Well, this has a kind of significant impact because Shanghai is not just a big city, but it's also an economic hub for China. So it's kind of psychological impact too. But first of all, there is fuel demand impacts too. Say in Shanghai, fuel demand has plunged by 60 to 80%. So this is a particular, you may say it's particularly serious in Shanghai now, but restrictions are similar all over the country. Say travel restriction across between provinces or even between cities. Well, so travel has declined a lot, and it would be common to see petrol sales declining by about 30 to 60% since the middle of March. So that's why China has now planned to continue with gasoline and diesel export in April. And in early March, you may have read some reports about China planning to suspend exports in April to ensure domestic supply, because independent refiners' run rates had declined quite sharply. But now, as domestic demand has dropped sharply, they plan to continue with exports in April again. So that's just one indication of how significant the impact on fuel demand is. Yes.
Reem, I wanted just to pick up on your presence now. Obviously, as we said in the earlier comment, you're former long-term correspondent of Reuters in Saudi Arabia, but now you are correspondent based in Italy. And from the point of view of Italy and obviously the center of Europe, and also Italy quite dependent on Russian imports, what does the sentiment feel like there in terms of the appetite from the street, if you like, to kind of take the hit, the economic hit of being robust with Putin and the Russians in terms of potential energy sanctions versus the actual economy's dependence on, and the politicians still unwilling to play that card?
Yes, Sean. Can you repeat the question, please.
I'm saying that the appetite in Italy, its vulnerability, obviously Italy is like Germany, less perhaps, but very vulnerable to energy security from Russia. And yet the decision to sanction Russian energy exports, what we're seeing reports on is that the street, the people, you are willing to have your lights turned off to defend liberal values, to take the challenge to, if the Europeans are not going to go in and defend the Ukrainians physically, they're willing to take a hit on the economic impact. I'm asking on that question, do you have a sense in Italy whether people are willing to take that kind of hit and so support a political move to sanction Russian energy?
To tell you the truth, I talk to random people in the streets, probably when I go get my bread or get my fruit or get my vegetables, and the sense is that people are really like. There's, if I want to get, like, for example, ravioli, let's say, for lunch, and I tell the guy, the owner of the shop, so how is business going on? How's everything going on? And he's the guy tells me, well, for now everything is okay, but the Russian invasion or war is like really weighing down on us, and the products are becoming more expensive. So people are really feeling the heat of higher prices. As I said, like just from the bread, from shopping bread or vegetables or fruit, or even fishermen having to pay more for diesel, and this will affect also like prices of fish. And this is this kind of sentiment is already like the war, higher prices, higher cost of living. Refugees, I think that yes, there is a sense that in Italy they are or collecting more in terms of like fundraising to help the refugees, or even accommodating more refugees and creating jobs for them as well, and in part like to help the humanitarian crisis. So in a way, as at the same time, like Italians have to pay more for gas. Like it's absolutely more expensive than before, and so it's already weighing down on sentiment. I don't know about if they're willing to switch off the lights, but at the same time not imposing sanctions, or preferring not to. What kind of political solution or decision they will
it's
come
interesting
up with.
To get a sense as we go forward where the political room to maneuver is on that in Europe, on this, because this obviously will be an ongoing decision challenge.
The thing is that they're much dependent on gas from Russia, and they don't have any alternatives. I mean, for the short term. Now they're coming up with more solutions. They're approaching more like countries to fill up the gap, or find solutions to have gas from alternative sources. But in the short term, there's not really like a solution other than getting the gas from Russia, which is like, as I said, essential for people's daily lives.
Nothing too immediate. Matt, meanwhile, back where people are really struggling, oil traders. I've ever seen two headlines more contrasting in the last week, where big conference in Lausanne, FT Commodities Conference, the traders, we're going to have to turn to the government to help us with credit lines, and the stress of volatility. And then this week, the record profits, Vitol reporting on, not that Vitol are reporting, but Reuters are reporting, world's biggest independent energy trader, record profits, $4 billion. Mercuria the same. How do those two things go together, or are they totally disconnected? Because when it's on Main Street or in banking, the banks get kind of slapped not to give out dividends if they need to, bolster, or not to buy back shares if their balance sheet needs bolstering. I'm just wondering how these two things go together amongst your customers.
Yeah, I think they're still in the pub from announcing those results yesterday, to be honest. But look, the thing you've got to look at on the VTOL results is their revenue doubled as well, right? So the cost of what they are selling went from 140 billion in 2020, that was their revenue, to 280 billion now. So that highlights the amount of credit that the banks are having to shell out right now when oil prices doubled last year. They've already gone up a third so far this year. And of course, this is going to have an effect on liquidity. Trade finance is something that I started on when I started at Traffy. And paying margin calls then when oil was at $20 a barrel was harder than it probably is at $120 a barrel, because the market hasn't really moved on from a fairly archaic bilateral trade finance system. But it's slowly changing. Blockchain, whether that will do anything, I'm not so sure. But the number of banks has consolidated massively in those 2 decades. But they will go where the flow is, and that is the VTOL and Traffys. Record numbers. I mean, the amount of, they traded 7.6 million barrels a day equivalent of oil, VTOL, and it's amazing. But 2022 is obviously going to be where they need to turn into economists, where they need to look at their trading books. And I think Reem just hit the nail on the absolute head. Ask a fisherman. Go to your local store and ask a fisherman, ask your mate who's baking bread, and all of them will say, well, I've got to try and up my costs because my raw materials, my feedstocks are going up and up in price owing to inflation. That's the demand destruction that I think will come in during Q2. And VTOL, Traffy, Mercury, Gumbel have certainly got their eyes on that. How they will probably offset it is to find ways, be inventive, and look at certain conduits in order to fill the void that Russian energy is leaving behind. But Reem's point about asking a fisherman is exactly what the oil market will need to do this year. It's the end user that where the traders have been complacent. It's a bit of a joke, but you sell 100 liters of diesel to a fisherman, and then you times that by 50, and then suddenly they can't afford to buy that diesel anymore. There's your demand destruction. So ask a fisherman. I think that's great.
You can't go fishing. Victor, perhaps in a strange way that China can maybe help to moderate this oil price if the oil producers won't, and that is by, instead of the world looking for more supply, maybe less demand from China would be helpful to this oil price. And we saw that yesterday when there was a sense that this COVID lockdown in Shanghai and may indicate a wider lockdown in China with less demand, and hence the price could ease off a bit. But Victor, we've talked each time, every month you join us, what the outlook for the year as a whole is. And the question again, last year we saw Chinese oil imports drop for the first time in 20 years. Are we going to see again this year, now at the end of first quarter, where we have a better sense of the year, that the possibility that a second year in a row Chinese oil imports could decline? Is that possible, probable?
Yes, I would say that's probable. Yes.
Probable.
No. Yes. Well, and you see now independents are running at quite low rates, well, 2-year low. See, and state-owned refineries are still running at quite high rates, well, because they were in early March they were trying to ensure domestic supply, but now demand has plunged, and so they tend to cut their run rates too. And there's increasing maintenance at state-owned refineries too in this season. So basically now the buying interest is quite weak among independent refiners at this moment. And so we see this as a trend. We are not going to, do not see it too well. We do not expect it to change very quickly yet in the near term. And it depends on how soon the country can bring the virus under control again. But this time it looks harder because we are talking about, well, infections in many cities, and in a certain city, say in Shanghai and in Jilin province, well, hundreds of cases on a daily basis. Well, because there's this kind of, well, shortage of medical workers as well and such stuff. And it's more challenging than even, well, except at the beginning of 2020, when the outbreak hit the country all of a sudden. And this is the most challenging moment for the country.
Well, no country in the world has managed to control Omicron. The illness level has been a little bit less, obviously, but the spread has been so rapid that no country has succeeded to do that. My question to you on that point is that obviously Shanghai, as you said, it's not a huge, I mean, it's a big city, 30 million people, obviously, but it's more a financial center rather than a manufacturing center, which is manufacturing is a bit removed further down in the southeast there where you are generally. Is there expectation that this shutdown will spread to the manufacturing areas?
Well, at this moment, some manufacturing has been impacted. But on the whole, the manufacturing will not be, well, hit too much if the country, I mean, if Shanghai is just locked down for, say, altogether 8 days, 4 days for half and 4 days for the other half. And manufacturing will be back to normal quite soon if this doesn't worsen, I mean, the situation, if doesn't worsen. So we are not expecting a lot of damage to the manufacturing yet.
If you say probable that Chinese oil imports will decline in 2022, by how much would that be? 20%, 10% on last year? What would your sense be?
Well, it wouldn't be so significant. I believe it would be, for this time, it might be below 10% because of the high price as well, the violence as well. And, you know, last time when we talk about the impact of high prices on China, well, there's a financial burden on the government too when high prices, when crude prices are high. Say, you know, the Chinese oil market is not a completely free market. The government regulates oil prices, I mean, oil product prices to a certain degree. Say, if crude average between $40 and $80 per barrel, the government would calculate oil product prices, well, on a normal level, at a normal level. Say, they will, well, include normal refining margin into the calculation of oil product prices. But if crude is above $80 per barrel, the government will cut the margins in the calculation of oil product prices, which means refineries will get less margin when prices are above $80. And if we goes higher, the margins will drop further until the margins are zero. So if the crude price is above $130, well, in principle, the government will not adjust its fuel prices, which means domestic oil product prices will lag behind and much worse margins for independent refiners. So what do they do? What do the refiners do? They need profit to survive. The government will have to subsidize state-owned refiners to ensure domestic supply. Say, but the subsidies will not be enough to cover all the loss, but it's still a very heavy burden on the government. Yes.
It certainly sounds like one. Let's get the survey question in quickly, because I'm very keen to understand the situation in China. China has been everything for OPEC over the last decade, or OEPIC, or whatever that acronym is, but maybe that's the Spanish version of OPEC. But OPEC over the last decade, accounting for 41% of additional daily barrels pumped globally between 2009 and 2019. I mean, that's an incredible data point, that China represented 41% of every new barrel pumped in the world in that decade. Will China's percent of additional barrels supplied over the decade ahead be more or less than the previous decade? Where the China outlook is, China's percentage of the incremental marginal barrel going forward, will it be more or less than it has been than the decade before? I think the answer to that is probably pretty obvious. Matt, let's just quickly go around the table. OPEC are meeting today. Any surprises? How short a meeting will this be?
No, I think it will be, they'll maintain course, which they've done for most of the last 6 months. If they were to, if Saudi or UAE, whoever is able to increase production, do that and pick up some slack from what they're predicting will come off global energy supply from Russia, I think that's a bullish signal to the market. And I don't like to use the word bullish at the moment because oil prices are up $270 now, $113 a barrel. I don't think that's anything to celebrate in a world that's coming out of a pandemic. Excuse me, and with the dreaded recession word looming,
and a war in between.
Exactly, and this is myriad issues at the moment. If they do increase production to pick up that slack, then it means there's no available spare capacity, and that will really put shockwaves through market when they think if there is another crisis, something that and somewhere else in the world something happens, then it's going to spook investors, and $113 a barrel could seem like a pipe dream.
Reem, do you expect any surprises today from OPEC, despite the words from Prince Abdulaziz? OPEC could surprise, as he surprised us in the early part of this agreement last year. No surprises too much these days.
According to delegates and analysts, unlikely to be any change, but there might be some revisions to the baselines, probably a little bit higher. Some analysts expect to go 40,000 barrels per day, like above the 400,000 barrel per day increase. So not really surprising. We don't expect any surprises, but we never know. So yeah, unlikely to be like a major change. To OPEC course, OPEC plus course.
Yeah. Let's get the survey result. Give Victor last word here this morning at all things China. Less 60-40, but still 40% of the room thinks that China will be more, that they will represent more of the incremental barrel going forward. Victor, looking at the immediate sort of global outlook, there's a big question mark about whether Russia or China will be willing to buy Russian oil, cheap Russian oil, whether China will be willing to support Russia in a very overt way in this war. What is your own sense of the buying of Russian oil, for example? Do you think there will be much appetite in China?
Well, independent refiners would hesitate to take more barrels from Russia because of the risk in, say, payment, shipping for them. But for state-owned refiners, they would find it more attractive. Find these barrels more attracting. Well, so for independent refiners, they had so far cut their buying of Russian barrels. But for state-owned refiners, they may have no issue with such barrels from Russia, and so long as they can fix the problems regarding difficulty caused by the sanctions, then there's no issue with them. That's my sense of it.
Okay, well, let's wrap it up there. Certainly very insightful comments, Victor, from China, to get an update. Really appreciate that. Matt, of course, as always, and Reem, great to have your insights. We wrap up our session today, Wednesday, the 30th of March, with oil prices trading up above 1%. And it looks like the slight momentum higher today, at least until the next headline comes out and maybe switches it around as we saw yesterday, but we'll wait and see. But the headline for me coming out of this session this morning is from Victor, and that it's probable that Chinese oil imports will decline for a second year in a row.
Yeah.
That's notable. Thank you. Have a great day. We'll see you
Thank
tomorrow
you.
at 10:30 UAE time. All the best.
Thank you,
Thank
everyone.
you.